It's lovely to be back here at the Stock Exchange again. Thank you all for coming out in person on such a busy morning, and welcome to our 2022 full year results presentation. I think most of you know me, but I'm Isabel Green, Head of Investor Relations. I'm joined here today by our CEO, Tufan Erginbilgic, and our CFO, Panos Kakoullis. Before we begin, I'm required to show you our safe harbour statement on slide 2. As always, the full set of results materials can be downloaded from the Investor Relations section of our website. We're going to start today with a short introduction from Tufan, and then Panos will present the 2022 results. Tufan will come back then to talk about his observations and priorities from the future. The presentation today is going to last around 45 minutes, so there'll be plenty of time for your questions at the end. So with that, thank you very much. Over to you, Tufan.
Thanks, Isabel. Hello, everyone. To those in the room, it is good to see you in person. For everyone watching online, welcome too. As this is my first results announcement at Rolls-Royce, I will introduce myself before handing to Panos. When I was approached last year about the opportunity at Rolls-Royce, I was drawn by the strong brand and reputation and its importance as a global company. There are only a handful of companies whose products have helped shape modern society. From the development of jet engine itself to the wide range of engines and systems we make today. Our ingenuity has helped bring the world closer. However, I also found a company that wasn't achieving its full potential, operationally or financially. I saw an opportunity to make a real difference and take Rolls-Royce to a much stronger position. Before joining Rolls-Royce, I spent 20 years at BP. I led the downstream business, and before that, the lubricants business through their turnarounds. I also spent several years on the board at GKN, and most recently worked in private equity. In all my previous roles, I have driven step changes in performance, set clear strategies, and delivered sustained improvements in profit, cash flows, and returns. Everything I've seen since arriving has made me even more confident in the potential to do the same at Rolls-Royce. I'm now going to ask Panos to run through the 2022 results. You are going to hear that business has delivered improved performance last year. However, you are then going to hear from me that these results are not good enough for a company like Rolls-Royce. We have higher expectations for this business, and we are clear on how we are going to deliver on them. Over to you, Panos.
Morning, everyone, and thank you, Tufan. In 2022, group revenue increased 14% to 12.7 billion. We had strong growth in revenue in civil aerospace and power systems, which were up 26% and 23% respectively, as volumes started to recover. There was a more modest 2% growth in defence. Operating profit increased by 197 million to 652 million, and that was driven by 3 factors. Firstly, improvements in long-term contract margins in civil aerospace. Secondly, increased profit from spare engine sales, again in civil aerospace. And thirdly, significant revenue growth in power systems. Now that was partly offset by the non-repeat of the 140 million foreign exchange credit in 2021, which was in civil, lower spare parts sales in defence, increased R&D in new markets, and also, common with many others, the impact of inflation, notably in power systems. Free cash flow improved by 2 billion year on year, from an outflow of 1.5 billion in 2021 to an inflow of 505 million in 2022. And again, that was driven by three things. Firstly, the improved cash flow in civil aerospace, which reflected strong growth in engine flying hour receipts ahead of shop visit growth. Secondly, higher defence cash flows. And thirdly, a reduced working capital outflow. Our net debt position had improved from 5.2 billion at the end of 2021 to 3.3 billion at the end of 2022. And that was due to the completion of our 2 billion disposal programme and the free cash flow that we generated during the year. Moving on now to the performance by business unit, and I'll start with civil aerospace. We saw a continued recovery in international travel in 2022, driving up our large engine flying hours to 65% of 2019 levels. The reopening of China towards the end of the year drove a further improvement in January, up to 79% of 2019 levels. This supports our expectations for large engine flying hours to be between 80% and 90% of 2019 levels as we move in 2023. The recovery in large engine flying hours was also complemented by robust performance in business aviation. We carried out 1,044 total shop visits in 2022, which is a 10% increase against the 953 in 2021. For 2023, we expect between 1,200 and 1,300 total shop visits, with a step up in large engine shop visits as higher flying hours activity converts into increased demand for aftermarket services. Engine deliveries rose by 15%, driven primarily by business aviation. We delivered a total of 190 large engines, which is 5 fewer than the prior year. We delivered 44 large spare engines, which is 8 more than the prior year. Large spare engines represented 23% of total OE deliveries, which is higher than the usual 10 to 15% as we build the spare engine pool to underpin fleet health and improve resilience ahead of the anticipated increase in shop visits. We expect spare engine volumes to remain at a similar level, that's in total terms, in 2023 and 24. As in all our businesses, supply chain management and wage inflation were more challenging in 2022. We managed this through commodity hedging, long-term supply contracts, and pricing. Now, there have also recently been 2 fires at important suppliers, one in late 22 and one in early 23. These have put additional pressures on our operations. Whilst they did not impact 22's results, they will impact cash flows in 23. Civil aerospace revenue was up 25% on the prior year to 5.7 billion, with OE and services up 23% and 26% respectively. Revenue is higher across all of our portfolio: large engines, business aviation, regional, and V2500. Civil aerospace profit of 143 million, compared with a loss of 172 million in 21. The year-on-year increase was driven by 3 things. Firstly, improved profitability on LTSA contracts, reflecting commercial discipline on pricing, costs, and contractual terms. This resulted in 319 million of contract catch-ups in 22, which compared to 256 million in the prior year. There was also a 51 million decrease in the onerous contract provision, which compares to a charge of 122 million in 21. That's was reduced the expected losses on those contracts. Secondly, higher volumes and a different mix of large spare engine sales, with more third-party sales to capacity providers than in the prior year. And thirdly, higher aftermarket profit driven by V2500, business and regional, as well as increased large engine shop visits. These were offset by 140 million headwind from the one-off foreign exchange revaluation benefit in 21, which did not repeat in 22. Our trading cash flow was 226 million, which is a 1.9 billion improvement on the prior year. This reflected the recovery in engine flying hours ahead of shop visit growth, which resulted in growth in the civil net LTSA balance of 792 million. Higher cash flows from spare engine sales, and also a smaller working capital outflow compared with the prior year, driven by a reduction in overdue debts and a lower cash outflow on the Trent 1000 engines. In 2023, we expect the change in the LTSA balance to be between 500 million and 700 million, which reflects a slightly lower level of growth than in 22 due to an increased number of shop visits, including more wide-body refurbs. We expect to continue to collect on overdue balances and target continued contract improvements, which should result in contract catch-ups of between 100 and 200 million. If we now look at defence, revenue was up 2% organically, and we expect a similar level of growth in 2023. Submarine revenues grew by 18%, which are at a relatively lower margin. Transport and combat revenues grew modestly at 4% and 2% respectively. Naval revenue fell by 19%, which reflected supply chain challenges. Defence is a long cycle business and does not immediately benefit from rising defence spending and geopolitical tensions. However, there is a supportive budgetary backdrop, and we've been successful with some large order campaigns. In 2021, we were selected to provide the power plant for the B-52 engine replacement programme. In 2022, the Bell V-280, powered by our AE1107F engines, was selected by the US Army for the Future Long-Range Assault Aircraft programme. Operating profit of 432 million was down by 10% year on year. The 11.8% operating margin was 1.6 percentage points lower than 21, but at the upper end of our expected range. The year-on-year decrease was mainly due to the non-repeat of 45 million of high-margin spare parts sales in 21 that we called out with the interim results. R&D spend increased by 9% as we invested in long-term programs that will create value in future years. Trading cash flow was up 13% from 377 million to 426 million. This gave a cash conversion of 99%, which is up from the 82% in 2021, mostly due to the favourable timing of a customer advance payment of around 60 million, which is not expected to repeat in 2023. Moving on to power systems. Order intake in 22 totaled 4.3 billion, which was 29% higher than in 21, with a book-to-bill of 1.3 times. Power generation continued to perform well, with growth in orders for power solutions to provide backup power for critical locations such as hospital and data centres. Revenue was up 23% in 22 to 3.3 billion, a significant rise despite the constraints to deliveries from the supply chain. Although absolute operating profit increased by 17% to 281 million, Power Systems operating margin fell by 0.4 percentage points. And that was due to higher costs, some of which were due to inflation and supply chain disruption, increased self-funded R&D, and some one-off charges including impairments and write-down of assets due to the Russia-Ukraine conflict. Trading cash flow was 28% lower in 22. Cash conversion was only 56% due to increased inventory to manage supply chain disruption as well as meet the volume growth. That was partially offset by structurally higher advance receipts from customers. Finally, new markets. These are our early stage businesses, Rolls-Royce Electrical and small modular reactors. In 22, new markets reported an operating loss of 132 million, which compares to a loss of 70 million in 21, and a headcount increase of around 80% to approximately 1,000 people. This is in line with the guidance we gave in 21, and for SMR was largely covered by third-party funding. Now the next slide sets out our summary funds flow for 22. We saw a 505 million free cash inflow from continuing operations, compared with an outflow of 1.5 billion in 21. The 2 billion difference year on year can be broken down into three categories. Firstly, our operating performance has improved by 1.2 billion. This was driven by trading growth in our established businesses and the increase in engine flying hours receipts ahead of shop visits costs, which caused a steep increase in our LTSA balance. Secondly, working capital was an outflow of around 500 million in 22 versus 800 million in 21, which was a 300 million improvement year on year. Inventories increased by around 900 million due to supply chain challenges across the group as well as volume growth. This was partially offset by just around 400 million of the inflow from receivables, payables and contract balances. This was led by advanced payments in defence and power systems and a reduction of overdue debts in civil of around 180 million. Finally, other movements, that was an outflow of 1.5 billion in 22 versus an outflow of 1.9 billion in 21, a 400 million improvement year on year. This reflected lower lease payments and derivative settlement costs, as well as similar tax and interest costs. Pension costs were lower than the prior year, as the UK defined benefit scheme is now fully funded and in a surplus position. Turning now to the balance sheet. We ended 22 with 3.3 billion of net debt, which is down from 5.2 billion at the end of 21. We completed our disposal programme in the year and used the proceeds to pay down 2 billion of debt. We retained strong liquidity. We agreed a new 5-year £1 billion sustainability-linked facility, which is 80% guaranteed by the UKEF, and that remains undrawn. We've seen positive momentum this year with rating outlook upgrades for Moody's, Fitch and S&P, but there is more to be done. We're committed to returning to an investment-grade credit rating through systematically improving our underlying cash generation as well as our profitability. I'm going to hand back now to Tufan to share his observations on and priorities for the business.
Thanks, Panos. In the future, I look forward to being more involved in presenting our operational and financial performance. Now, I would like to start by sharing my early observations and some key issues that I see. I spent the last few months learning about our company with the teams, including time in our largest sites in UK, US and Germany. We have great people who are dedicated and committed to the work we do. We have some of the best products and solutions in the world, supporting the needs of our customers in complex and heavily regulated industries with high barriers to entry. We have good market positions in our key segments. The businesses we have today are improving as our end markets recover. As Panos showed, our results improved in 2022, helped by recovering markets and some benefits that will not repeat at the same level. We cannot rely on market recovery alone to deliver better performance in the future. I have much higher expectations from the business, and improvements need to be delivered on a sustainable and underlying basis. Rolls-Royce has been underperforming for an extended period. Our 5-year TSR of negative 67% is evidence of this and shows this is not just a COVID issue. Cash generation is unsatisfactory and our debt is still too high. Too much of our gross profit is simply covering our overheads and interest payments. A weak balance sheet and sub-investment grade credit rating limit our ability to invest in growth for the future. We have recently completed an extensive benchmarking study that confirmed our margins are below the competition on a like-for-like adjusted basis. Our low operating margins and relatively high fixed cost base leaves us financially exposed when uncertainty impacts our markets. As a result, in the last 5 years, even excluding 2020 due to COVID, we have averaged a return on capital employed of just 3.5%. We have also not had sufficient strategic clarity to make investment choices. Instead, we have been trying to keep too many options open. More importantly, let's turn now to the overall proposition we are looking to create for investors. I believe we have the potential to be a much higher quality and more competitive company. A company focusing on sustainable earnings growth and cash generation with a winning mindset and culture that drives and rewards outperformance. Underlying performance improvements will drive higher operating cash flows. This, coupled with disciplined capital allocation, will grow our sustainable free cash flow. A strong and flexible balance sheet will allow us to grow shareholder distributions and fund future growth. We will build a strong Rolls-Royce to deliver this proposition. We are already in action and we are proceeding with a sense of urgency. This slide sets out our priorities and, in a way, our philosophy, how we are thinking about running this business, which is different from what has been done in the past. These are the priorities we need to focus on to deliver the Rolls-Royce proposition. They deliberately overlap. They will drive better performance independently and collectively. First, we will improve earnings and cash potential of the business. The focus will be on quality growth in profits and cash rather than just revenue and market share expansion. Second, we will create an efficient business with a competitive cost base and improved operating leverage. This will make us more robust to the external environment. Third, we will target sustainable cash generation and will deleverage our balance sheet at pace. We remain committed to recovering our investment-grade credit rating and resuming shareholder returns. Fourth, we are developing a clear and granular strategy to prioritize investment opportunities. We will allocate capital centrally to the attractive market opportunities and programs. And fifth, we have an important role to play in the energy transition and remain committed to achieving net zero. We will develop a robust framework to make the right choices. We will focus our investment on the most attractive market spaces and programs, evaluating all energy transition opportunities to ensure we are delivering the best value for Rolls-Royce and the shareholders. We must only invest in new technologies where we are differentiated, where the market opportunity is sufficiently large, and where there is a viable business model and synergies with our existing activities. By adding complementary capabilities, we can build winning propositions and de-risk the group. Partnerships will be a purposeful part of our strategy. All this will be underpinned by our most important priority: to ensure that our people and products are safe. This is the right thing to do. We care about our people and the people that rely on our products. We have launched a transformation program to deliver a step change in performance systematically and at pace. I'm chairing the weekly transformation planning group, and the whole executive team will spend time together each month to focus on this. Work has already started on critical work streams. To support this, we have appointed a Chief Transformation Officer reporting to me directly. We have 7 work streams. We have appointed senior leaders to the first 4: efficiency and simplification, commercial optimization, working capital, and strategic review. I will talk about these in more detail on subsequent slides. The business improvement work stream is being led at the business unit level. We have set challenging targets based on rigorous peer benchmarking analysis. This identified the performance gaps, our relative position in key businesses, and scaled the potential for improvement. We are now working on the detailed plans to deliver that potential. The remaining 2 work streams, changing the culture and performance management, are critical to lasting change. We will drive them by building the right mindset with our teams to be proactive and timely in our actions so that we can manage performance effectively. In January, I got together with our top 80 leaders for a working session on delivering change. We focused on how we will lead the business through this transformation together as an aligned organization where everyone is mobilized and knows their role. We have also engaged the whole organization in an extensive communication effort on the opportunity ahead. This will be an ongoing activity. I'm going to share more details about some of the work streams, starting with efficiency and simplification. This is about identifying and delivering sustainable improvements across the whole group, focused on 3 things: organizational review, footprint consolidation and optimization, direct and indirect third-party cost efficiencies. This will improve our operating leverage so that we are competitive and robust to the external environment. As you can see on the slide, our costs are high compared to our gross profit, and we are a long way from best in class. Across the group, we have work underway to identify synergies across all our divisions and functions and to simplify our whole organization. A significant part of the cost reductions during COVID were activity related and largely in our civil business. These costs have been going up again as activity levels come back. Our efficiency and simplification plans look to achieve sustainable cost efficiencies across the group that take the activity increase into account. We will also be looking to capture efficiency opportunities within each division and function. We are already in action on this. For example, in power systems, we are already removing duplication and optimizing the organizational setup to accelerate decision making. Commercial optimization is about getting the right reward for the risks we take and the value we create for our customers. It will focus on civil aerospace and power systems. A stronger Rolls-Royce will be a better partner for our customers, more able to deliver operationally and invest in product development. To support this, as part of our executive process, we established a group operating committee. I have already met with a number of our largest customers, and they understand this. We have also changed our commercial discussions on new contracts and renewals. In civil aerospace, for example, we set up a task force to review all the large engine LTSA contracts. We are also working to lower our product costs and drive up the margins in contracts to ensure we achieve the returns that are aligned with the risks that we take. It is early days, but results are already starting to come in. We improved several onerous contracts on the balance sheet at the end of last year, and we achieved double-digit price increases on spare parts. We will drive further improvements this year to the margins of both profitable and onerous contracts. And in power systems, we have already been able to renegotiate the prices with a benefit to profit and cash flows. These efforts continue as we speak. We are becoming a commercially minded and capable organization. At the end of 2022, let me talk about working capital, by the way, right now, and which is actually very linked to commercial optimization in a way. And at the end of 2022, we had $25 billion pounds, actually, gross working capital tied up in the business. Our net working capital, $2 billion higher than our position before the pandemic, despite revenues being lower. We are confident that we can deliver a significant and sustainable reduction in working capital across the group by deep diving into the operational value chain and optimizing each of the components of working capital. Our immediate focus is on improving inventory management and recovering overdue receivables. The final work stream is our strategic review. This is already underway. Let me start by making it clear that this is not just about what businesses should stay in the portfolio and what we should sell. My early take on the portfolio is that all of our established businesses have the potential to create significant future value. One of the outcomes of the strategic review will be to determine which areas we will invest in and which we will not. To support this new strategic rigor, we will centrally allocate capital to the most attractive market spaces or programs. This is a change from the past, when there was more autonomy within the individual businesses. This more disciplined approach will mean more effective resource allocation of limited available capital. We will continue to support critical safety programs as well as investment to enable the business to execute on the opportunities presented by the market recovery. But we cannot continue to allocate capital to projects that have low returns. Beyond strategic clarity, a granular strategy will be an effective alignment and performance management tool, as well as changing the culture. A clear strategy supported by the right performance management can be cascaded down and used as a powerful engagement tool to align the whole organization. We will have a strategy implementation plan that makes it clear and meaningful to individuals how their business performance and individual objectives contribute to the strategy and midterm goals. With the right engagement and processes, this not only aligns the organization, but also becomes a good performance management tool. We will have the new strategy and midterm targets for you in the second half of this year, along with the metrics we will be reporting against to track and measure our progress. Before I wrap up, I would like to share our view of 2023 and our guidance for financial performance this year. In 2022, our performance improved, driven by good underlying progress, but there are also some benefits that will not repeat at the same level. These are detailed in the supplementary slides for you, along with some additional guidance detail we hope you find useful. We expect to achieve higher operating profit and cash flows this year, reflecting the actions we are taking and the market growth as wide-body flying recovers and as we convert our order book into profits. For 2023, we expect to deliver operating profit of 800 million to £1 billion, which includes a benefit of 100 to 200 million from targeted contract improvements versus around 300 million last year. We expect free cash flow of 600 to 800 million, which factors in 500 to 700 million of LTSA creditor growth versus the growth of around 800 million in 2022 as shop visits increase. It also factors around 200 million year-on-year headwind associated with the unwind of legacy OE Boeing concessions and around 100 million impact of 2 fires at suppliers late last year and early this year. We expect this 100 million cash impact to reverse next year. There are environmental uncertainties and challenges in this guidance. We will need to be agile and commercially minded as we manage the external risks of inflation, supply chain disruption, interest rate rises, and recession. So, to summarize the key takeaways, we aim to create a high-performing, competitive, resilient, and growing business. We have a significant opportunity to expand our cash generation and profitability. We are already in action to improve underlying performance. We will set a granular strategy with midterm targets. We have a lot of hard work ahead of us, but we are moving fast and there are big potential rewards for all of our stakeholders when we get this right. Thank you for listening. I will now open the meeting for questions.